welcome to a Gartly Advisory client webinar production live from Ormond, Melbourne, outlining the 2026 federal budget.
G'day everyone, and my name's Geoff Gartly. This afternoon we had a client seminar talking about the federal budget, and we have published our complimentary copy for anyone to review. Just bear in mind that this is legislation that hasn't yet been enacted, so there could be some changes. It's for general use. We hope you get some benefit from it, and by all means, if we can assist you further, please contact our office in Melbourne on 039597 9966. We'll start from the start. Welcome, everyone. I'm just going to do, before we start, just mute everyone. And I'll take questions at the end, but I won't take questions about your particular circumstances, but this is a public forum, so it's probably not appropriate. Now, I better make sure that I share my screen, hey? Rightio, here we go. So welcome everyone to our quick, hopefully 30 to 40-minute seminar about what's happening with the budget. I'm sure you all watched it on Tuesday night, like I did, and hopefully didn't throw a brick through the TV. We'll start with the disclaimer because all good lawyers expect you to disclaim. The federal budget is based on the fact that it's laws that came out on Tuesday night, and they're only proposed, so they haven't gone through the final legislation, which may differ down the track. This information doesn't constitute financial, taxation, or legal advice, and you should seek that for your own circumstances. And also, this is boomer bashing will not be tolerated. Oh, they're still coming. Okay, so welcome those that are turning up just a bit late, but that's we're just about to just get into the nitty-gritty. So obviously, I think most people, I'm not sort of saying anything that's not out of play, is that the budget was a bombshell. And if you look at social media, I think probably 80% of people are pretty upset about what's happened. And partly it's because of the comment that, yes, how hard is it for the 50th time? The exasperated quote from Albo saying that they weren't going to introduce any changes to negative gearing and capital gains tax. And for whatever reason, they've chosen to go down that path. So it's going to impact everyone from young to old, especially those who've already structured their affairs for the future. And now they have to revisit that. And I think in most cases, for most people with small business, which is where my focus is, it does mean some changes. It does mean that maybe their financial retirement journey's changed. But it's not all bad, but there is certainly some ways that we'll need to look at focusing on different things. And already there's people out there considering their options, whether it's dramatically. I think it's a bit early. So basically, what I'm just saying today is don't panic, take it all in. Over the next 9 to 10 months, we'll work through your situation and see where we think we can go. What's happened in the past, family trusts? So that's about my question that people are asking me, because we do a lot of family trusts. Are they still useful? Yes, they are, and we'll talk about that. Why would you have put me in one if the government's going to change the rules? Well, we can only do what circumstances allow us at the time. So, and of course, they still are useful for estate planning and a few other things. And the writing hasn't been put in legislation yet, so it could change. So today we're going to talk about the three big bombshells, which is basically negative gearing, CGT, and discretionary trusts. That's the main area I'd like to cover off on because that's the main thing that affects small business clients. And so it's a 30-minute flow. We'll work through setting the scene. We'll talk about investment in property and capital gains, the 30% minimum on tax on gains. We'll have a look at a couple of little examples. We'll talk about discretionary trusts. And then we'll also just talk about some planning action issues that we may want to talk about with me down the track. So here's a quick overview of maybe the top 7 items in the budget. So we're looking at personal tax cuts, a little sweetener of $250 to get you over the line. A couple little personal tax cuts for lower income people, which you notice 15, 16, 14, well, we're 30% for certain things. So it's a bit of smoke and mirrors, the budget. A lot of smoke and mirrors, let's be honest. $1,000 to sweeten those that are work-related expenses. There's still a little bit of clarification as to what that means and what you can and can't claim. Uh, then we're going to get to the big items, so the capital gains items. Yes, we'll talk about that, Ross. Give me a minute. We haven't got to trust yet. I've got that on my list. Capital gains tax overhaul. The 50% discount is big. We've got negative gearing restrictions. We've got discretionary trust changes, and then we've got small business tax measures. So we're going to go from 4 to 7, and then we're going to finish off with you guys going home and having a beer to soak up your sorrows and get on with life because hopefully some of these won't go through. And if they do, I reckon the rate we're going, we're going to see Pauline changing the world. Okay, so an executive summary, we've got time clocks. So we've got negative gearing. That's going to start on July 27. Rental losses established on residential investments bought after the announcement of Tuesday will be quarantined to residential property income. So we'll have a talk about that. We'll talk about the big one that's going to affect lots of people, young and old, is the 50% discount being replaced and a minimum of 30% tax on real gains. And then what also affects a lot of my clients and small business is discretionary trusts and the 30% minimum tax. The government, out of all of that, probably discretionary trust is their least of their worries because they know that they don't get votes from certain people. But having said all that, we need to look at how that impacts on people moving forward with their estate planning. But don't panic, structures, purchase dates, and stuff like that we'll need to have a look at. So here are the key dates to anchor as for the conversation around what's going to be happening. So we've had the budget date. We've now got 1st July 2027. So we're critically aware of certain clients that we'll need to have a look at straight away. Some moving forward will do nothing, and others will change the way they've done things, but still keep the same structure. So we've got negative gearing changes starting on the 1st July 2027. We've got the 3-year rollover relief, which is interesting for discretionary trusts because there's some implications around stamp duty and a few other things, which I'm not sure how the government will address. And then we've got the 30% minimum tax on discretionary trust starting on the 1st July 2028. And then we've got election thereafter. So some of these are delayed to just start before the election. So maybe the impact isn't as great. You definitely, a couple of them you can see are playing around with different dates and times and rates. So let's start off with negative gearing. So presently, lots of people have used negative gearing for rental losses and reduced other income. It's got people into the market. It's not just for young people, for old people, it's all sorts of people. So our client range has certainly used and benefited from negative gearing. Whether politically it was the right thing to do, the government has decided that from the 1st of July, that for established residential properties acquired after this date, losses will be deducted only against residential property income, including capital gains, and the excess losses are carried forward. So if you've got a really doozer of a property and it's not going to make a gain and it's creating losses because of the interest, you really got to look at your options about getting out. New residential builds remain eligible for negative gearing. Properties held before the announcement are grandfathered for negative gearing until sold, and super funds, including SMSs, are excluded from the negative gearing changes. And we'll go through a couple of these examples. So, one of the questions we've had, what's a new build versus an established and the property fork in the road? So let's have a look at some new build examples. Off the plan apartment, great, you can go buy one of them. a duplex replacing one freestanding house. Now, these are things that are coming straight from the budget paper. Residential construction on vacant land and newly built property first sold after occupation of less than 12 months. So if you can find a property that's someone's lived in and I believe hasn't been it's been occupied for less than 12 months, you might be able to be covered under that. However, on the other side, established property with an extra bedroom added, no, you can't get anything there. Knock down and rebuild, replacing one house with another, nope. Granny flats next to an established property, no. And newly built property acquired for more than 12 months before first investor sale. So if you buy a property and sit on it for 12 months and then move in or sell it, that's not work. So the idea of deliberately trying to look at the housing supply, and new looking is not enough. The property must be genuinely added to the supply, and that's their approach. Interesting commercial properties are excluded from the negative gearing approach. It's very much around residential properties. So we've had a couple of questions about negative gearing, and for most people realize that negative gearing is a net loss, and that's what people claim a tax deduction against other income. So it's not necessarily the interest, it's a negative amount that you're incurring. So if you've got a rental property worth 35,000 in rent and you've got interest and other expenses worth 50, there's a net loss of 15. So under the new rules, under the old rules, the 15K could reduce the taxable income, give you a tax deduction, and hopefully if your property was going up in value, you're ahead. However, under the new rules, that's not the case. So that gets quarantined, and then you can offset that against next year's profit if you're positively geared, or eventually it goes off the capital gains amount. So it's very important to understand how you structure your investments in residential properties going forward. And that might be whether you're keeping existing loans, reducing them, keeping existing buildings. It's all up for discussion. And it's really important for clients to now plan rather than just keep buying properties that aren't going to be able to be negative geared, or they're buying the property in the hope that the rules turn around. So careful planning may also result in your home being available to negative geared. So if we've got Bill who happens to have a negative geared or a mortgage on his house and he says, I think I might buy another one and negative gear this one, that's still okay, providing the contract and the loan was prior to budget night. So you can still, under the proposed legislation, convert that to a negative geared investment. So it's a proposition that might be worth looking into, especially if you have a mortgage on your home. You might want to, if you can, turn that interest into interest only and eventually turn that one into a investment property. Again, careful planning because there's other considerations. Depends on what you're trying to achieve, whether you're looking for superannuation, you're going to try and do the downside of the contribution. There's a whole lot of things to take into consideration. That's why definitely don't panic at this stage. The next thing is the end of the simple 50% discount for many assets. So, we would do a tax return. If you held it for 12 months, you get half the gain. So effectively, the tax rate, if you're on the top tax rate, was 25%. Now that's out the window as of now. Eligible businesses, before they get the 50%, now post July 2027, cost base indexation adjusts for CPI, taxes then calculated on the real gain. And there will also be a minimum tax rate of 30% on capital gains. So, it's going to mainly impact on those where a client's taxpayer's marginal rate is lower. So what traditionally would happen is clients would say, right, I've got a property, it's made a really good gain. I'm going to be working for the next 5 years. So I'm 60 now, 65, I'm going to retire. I'm going to go onto a tax-free pension. I might sell my property and then I don't pay as much tax. A legitimate, previously great strategy. And probably a lot of my clients would be still thinking that was up to till Tuesday a great strategy to work on. Now that's all changed. So they may still get it, still may be feasible to sell it that way, but unfortunately the gain is going to be taxed a lot more. And let's have a look at as an example in a minute of that. So for those that are got this property prior to budget night and now they're sitting on like the old pre-CGT asset, there's a shandy approach to the game. So we need to get a valuation. So the valuers are going to be busy. Supposedly the ATO are going to bring out some sort of tool that will help us. We'll wait to see on that one. And so at the end of June 2026, 1st July 2027, you've got a value. And up to that date, to keep it simple, we get a discount capital gain on that. Post that, when having index and the 30% minimum tax framework throws in. So these pre-CGT assets to some degree will be, or pre-2027 assets will have a better value and people will supposedly hold on to them a little bit longer, but it really doesn't matter because it's quarantined to that date. And beyond that, we've got the indexation method, which used to be around many, many years ago before I was born. No, before I think Howard changed it or someone changed it partway through because they thought it was a more better way to get people to invest. So let's have a look at a bit of a calculation for us on how the impact is going to be. So I've just used some basic stuff. Don't want to make it too complicated. So we've got a house worth 100,000 if you could find one, been indexed to 124. It's got a sale price of 190. There's technically a nominal gain of 90 and a taxable gain of 65 using the indexation method. The old method, the good method, resulted in a 45,000 taxable gain and a discount method of 20 grand less, basically. So as we can see, based on that scenario, we're up for another 14 grand in additional tax. So we've got 12 months to sort through this, but down the track, it's definitely going to be penalising the people. Now, why is that? Because originally, as we said earlier, someone on a low tax rate, around 15%, would be paying little or no tax on a gain, especially a retiree. Now, they're going to be paying a minimum of 30%. So that's a bit of a change of strategy. It's going to cost more in tax to sell a property down the track. And we've probably seen interesting 12 months of people deciding to get out of their properties. But anyway, so here's another interesting way that we can look at it as well. So this is a bit of a shandy of the proposed rules with the indexation. So we've got, if we look at the current rules, we get a 50% discount. So the total taxable gain is 250. That's your standard way of doing things. Under the new rules, effectively, we've got to split the calculation and we've got a 50% discount up to 2027. And then beyond that, we've got an index. And I've just done some rough calculations and worked out it's quite a, well, there's an extra zero in there. It's quite a bit of difference in terms of what people are going to end up paying. So the better outcome, obviously, the higher the inflation, the lower gain. I don't think we'll ever get huge inflation. Well, hopefully not. So the other way, the 50% rule definitely was great in most cases. And in this case, Bill would definitely be worse off. And I think that's the idea, is to reduce the supply and get the government some more money. So a different environment. The next question I get was, well, maybe we'll put some super and dilute that whole capital gain, But again, the government set up over a few sherries and thought, yeah, people are going to try that. What do we do? So we believe that the commentary suggests that they're likely to treat the 20,000. So if you put 20 grand into super, they're likely to put it against other income and still charge you the 30% on the capital gain. So we're still to see what the legislation does, whether it allows super deductions to offset against gains, whether the gain sits in a separate basket. and I can't see below that because this thing there, and how the trust loss and the CGT account will operate together. So we've got a whole lot of issues that haven't come out in legislation yet, and we're waiting to see what will happen. So that's why there's no rush at this stage because it's obviously got to pass Parliament and there's got be a whole lot of discussions and all the rest of it. And often what comes out in the budget doesn't always end up being the same in law. But we'll just see where that goes. So, but at this stage, if that was the case, again, they're trying to get you to pay capital gains tax on the 30%. Um, I assume, and I hadn't picked up, I was just thinking about um, the below the 12 months, there was no discount. So that means that would probably still apply. It'll just be the total gain if you sell something within 12 months, but the 30% tax will apply regardless. And right. Um, Now, while we're talking about super, I know a few people have asked the question, does the self-managed super fund, CGT changes, was there anything in there? Not directly in the way many thought there might have been. So there has been talk pre-budget about removing self-managed super funds' ability to borrow, things like that. None of that came in. So maybe that's the next budget, maybe not. The broader budget introduced major CGT reforms, but it didn't impact on super. So the key takeaway for our self-managed super fund trustees today is that no immediate CGT changes. The biggest issue is the member balances with the $3 million, which happens in July. And at present, it looks like the unrealised gains in relation to that appear to be abandoned. And there's issues around valuations, which we've got to do for anyone that's got 3 million. So it looks like super funds have been saved for this year. And at the moment, maybe more attractive if you're going to hold property. It could be a self-managed super fund, which sort of does go against the government policy because they're not very favourable. They don't particularly like self-managed super funds either. They'd much prefer you to be in a big industry or union fund. So that's quite interesting in that regard. Now, the final thing is the death tax and testamentary trusts and trusts in general. So we know that 30% trust tax is coming in. We know that we've got different types of trusts. And in fact, I think this particular one went ahead of what we should have talked about, or I've gone forward one. Let me go back to this one. Somehow that slide pack's gone out of pack. So we'll just go through that and then I'll go back to your testamentary trust in a minute. So we've got discretionary trusts and 30% minimum tax. So we all know that governments over years have always threatened about closing down discretionary trusts. And they know that they couldn't directly close them down because it is a great tool for estate planning. But they've now worked out a way to tax trusts like companies, but the difference is they don't want them, so they're not going to give you the credits. So ultimately, what they're saying is that we'll pay you out if you get a distribution from a trust, you'll have to pay a minimum tax of 30% from the 1st July 2028. So using lower income people like kids and stuff like that is not going to be as beneficial. But if you're already earning a good income or you're paid a wage and you're already on a reasonable tax level, trust is still certainly useful. So the trust must bear the 30% tax regardless how distributed with credits to eligible beneficiaries. But I think they'll be non-refundable credits. So, so as it says, it doesn't reduce the tax advantage. It just increases the importance of asset protection. We're beneficial on 30%. There's little or no additional tax, so there's no real difference. It's where we distribute to low income adults, minors, bucket companies, and all that sort of stuff that we'll need to review. Um, the question that a lot are asking at the moment is it property should be held now by a trust or a company or an individual? It's still early days, so we need to just work through the legislation and see the models that are coming out, and then we'll determine down the track. But there may not be any difference if it's taxed at 30%. There'll be some interesting lawyers coming out with some new and accountants coming out with maybe some interesting changes towards family trusts, whether or companies where there's some hybrid stuff going on. We'll wait and see. Obviously, the tax office don't really want people, rotting the system, and obviously the government wants you not to use a family trust. So let's see what happens. But certainly, family trusts are still a good estate planning tool. Um, so who's in, who's out, and who should be reviewed? So not in the scope and excluded is fixed trusts, widely held trusts, complying super funds, which we know about, special disability trusts, discretionary estates, and charitable trusts, and some primary production and vulnerable minor income type trusts. So the first ones to get the review that we need to look at are family trusts, trading trusts, investment trusts, trust distributing to low income adults, and trust distributing to corporate beneficiaries. So all the ones that government think that people are ripping off or getting benefits of the low incomes, so they want that out the window. So who does it impact on? 350 active small businesses operating through discretionary trusts. But more than 90% of the businesses are not expected to be affected in a given year. That's what the government's saying. Is this true? I'm not sure. Sadly, like a lot of my clients, as you would know, if you're in small business, work pretty hard, and the use of giving distributions and profits to family members, not just mum and dad, is something that family trusts are allowed to. And in the past, it's a good way to spread the income across the family because everyone in the family benefits. Um, like in our family, we all work in the business and we all make sacrifices. So I think it's sort of a bit disappointing that they have not thought about small business in that regard. Now I'm going to go backwards to the one that I should have spoken to before, which was the tax on trust and why this can look like a death trap for testamentary trusts. So, for those that aren't aware, a testamentary discretionary trust is often created because someone's died. So, in your will, you put in there that you want to set up a discretionary trust, a testamentary discretionary trust. However, that trust is later now subject to the 30% minimum tax, particularly when the income would have otherwise been distributed to lower tax rates or minor beneficiaries or your kids that might be young at the time or as in like young adults. Um, so what some commentators are saying, well, it's not a tax on the transfer of assets at death, it becomes a tax cost on inherited wealth through a testamentary discretionary trust. So it's why the advisors are calling it a death by tax by stealth. Or a death of 1,000 cuts. Deceased estates itself appear to be protected, but they're only temporary because they're the administration of someone that's died, whereas a testamentary trust is a long-term structure that continues well after the estate administration. So obviously that'll be something down the track that people will look at and decide whether it's still a good estate planning tool, especially if it was used to help assist if you died a bit younger and you still had younger beneficiaries or young adults. So no doubt we'll wait and see what the gurus come up with and then see how that fits into estate planning. Um, so so people are now starting to talk. I think it's still early days. We just need to be caution because there is supposedly some rollover relief, but we don't know what other implications that will have. There's a company off, maybe there's an offer a 25% business tax rate where the dividend imputation system might help. But again, we need to see how that rollover would take place. Because what the government is saying is, okay, we don't want you in a trust, but we realise that you're set up that way. We'll give you the option of moving to a company, and we'll give you some rollover relief. Now that will work for some people, but it won't work, I don't believe, for those who already have property in a trust, especially if you negative geared something, because that may freshen up the capital gains rules into that post July 2027. So we're going to be watching that cautiously and not make any rash decisions just yet, but we'll do something down the track. We've also got the option of maybe going into a fixed trust, which again is sending out the distributions like a company in proportion to the shareholding. So it's basically that there's no discretion, which means that the beneficiaries would be who own that would just be paying tax. It would be getting their distribution on a fixed proportion. So there's no creative changes in terms of distribution. Or it may be the best option is just to stay put where you are. We've got beneficiaries that are already on high incomes, and there is still some benefit if they're on the 30% as opposed to 45%. Or we've got some asset that we don't want a high paying individual to receive the capital gain because they were already on 45%. So there is still some planning that we can do. It just is somewhat reduced, unfortunately. So we'll be talking to clients over the period of time, and we'll be looking at, what people are doing with property investors, considering new builds, whether they're looking at long-term sales, whether SMS property investors need separate messaging and review. At this stage, probably not. Whether you're going to convert your home into a rental property. Things like that we'll still have a look at. We've also got to look at those clients that got large unrealized gains and whether that should be, we look at next year over the next 12 months, whether some of that should be gone because of the new 30% rule. And then of course I'm not a age pension expert, but that may also come into effect. So there's a whole lot of things to look at. It's not just better get out of this tomorrow because I'm going to be taxed at a higher rate. And then of course we're going to have a look at those trust clients, which we'll go through over a period of time to establish whether it is beneficial to move to a company. We also don't know whether Pauline or anyone else or a Liberal gets in and changes the rules again after 2.5 years, or whether the government under pressure might water down some of these impacts. They seem pretty resident that they're going to go ahead with it all. So I think we have to work on that basis. So discussion points for you guys is, are you planning to buy an investment property? Is it a genuinely new build or is it a second-hand one? And what's the benefits? I think the benefits will be you'd have to get a reasonable rent return to offset the fact that you're now paying higher taxes and not getting that negative gearing. So that's going to push the rent up for younger people. Eventually long term, of course, there is some safeguards at the moment, but long term market forces will have something to do with that. Are you going to sell off an asset pre or post July 2027? Looking at family trusts, and would a company be better match for your commercial purposes? So there's a whole lot of things that we'll talk over the next 12 months about. Obviously, I'd like to see a bit more of the legislation coming through and how that's going to impact on our clients before we make any final decisions. And hopefully that will happen pretty quickly. The last thing I'd like to just have a quick talk about is small business concessions. The four small business CGT concessions are unchanged. The 15-year exemption, the 50% active reduction, the retirement exemption, the small business rollover are still there. So if you're a small business which has a turnover of 2 million, interestingly, they haven't changed these thresholds for a while. $6 million worth of assets or $2 million worth of turnover. But if the gain falls outside the concessions or only partly qualifies, there's obviously the 30% minimum tax on the real gains. We need to start looking at that. So trading trust owners might want to restructure. There'll be some rollover relief, and there'll be some sale of, no doubt, planning of a business asset, testing all the conditions to make sure that they apply, and looking at the super caps so that we can actually see if we can save on super, things like that. So there's a lot of water to go under the bridge, as they say, before we end up, finalising the law and the changes. But on the face of it, it certainly is going to impact a lot of people. So I'll finish off with a disclaimer. Most of this material, if you're really excited about it, you can get on the budget page, which is where I've got most of this material. It's for general discussion. Don't go and act on it yet, because there's still legislation still to come through. And of course, if you worry to send us an email or contact, and we can start the review. We intend to go through most of our clients that have assets to work through some issues, and that'll just take time. And we'll just see where it all ends up. If you're buying any new assets, that's probably a priority at the moment, because we'll have to scratch our head and work out the best way. So I'm just going to open the floor up for any comments before we close off for the evening. If I can work out how to unmute everyone. Everyone can unmute, basically, I think. Yep.